Hello and welcome to this episode of Standard Deviation, my column and video series. I'm TCA Sharad Raghavan, and today I'm going to be speaking to you about how general elections 2024 have come at a particularly bad time for the private sector. That is, all signs point to the fact that the private sector is ready to invest, but election-related uncertainty is making them wait. And this isn't, of course, a good thing for the Indian economy. Indian elections, especially at the national level, bring a level of upheaval that's not seen by any other event in the country. This, of course, extends to the economy as well. While it is well established that the elections and the model code of conduct bring a slowdown in government capital expenditure and new announcements, what's notable about this round of Lok Sabha polls is that it has come at a particularly bad time for the private sector. That is, several signs heavily imply that the private sector is raising its hammer to strike down on the anvil of investment, but the uncertainty brought on by the elections is forcing it to wait. This wait will likely extend all the way till mid-July, following the presentation of the full budget for the year by the new government. Now, this delay is nobody's fault, since elections are essential and the timing is largely set. But it is certainly coming at a very wrong time. Although India is shining bright as one of the sole beacons in the global economy, this is not hard to do in a difficult global environment. The private sector ramping up its spending would have been a welcome boost to growth at a time when it is currently being carried single-handedly by government spending. Several signs are in place that show that the Indian private sector is ready to invest and is likely even willing. The most striking sign in the recent past has been the growth of bank credit to large industrial companies. As ThePrint reported earlier this month, bank credit to these large companies rose to above pre-pandemic levels for the first time in 23-24. The growth rate in this credit disbursement too was the fastest it has been since 2018-19. In addition to this, companies have increasingly been raising money from the bond market, with private sector bond issuances touching 8.4 lakh crore rupees in 2023-24, the highest in at least 6 years, and a pretty healthy 12% higher than the previous year. Now, large companies in India spent the post-pandemic period reducing their debt levels and cleaning up their balance sheets. So now, if they're once again borrowing from banks and the bond market and in increasing amounts, then this is a clear sign that they are getting ready to invest. The other indication that the time is ripe for private sector investment is that capacity utilization, which is a measure of how intensively existing assets are being used to produce the output, is reaching the point where companies start looking to expand their capacity. Data with the RBI shows that capacity utilization has been hovering around the 75% mark for several quarters now. This mark is considered by most investment analysts as the threshold at which companies decide that new capacity is needed to keep up with demand. Now here's the other key part. Post-pandemic demand has been notably uneven. While SUVs and luxury cars have been witnessing robust growth, smaller cars have seen sales remain more muted. Higher-end mobile phones are selling strongly, while budget phones are growing in single digits. In real estate as well, the surge in sales is being driven by luxury houses. Yet, some signs are emerging that rural demand is starting to pick up. A Nielsen IQ report from earlier this month found that rural sales for the FMCG sector in the Jan to March 2024 quarter outpaced urban sales for the first time in 5 quarters. Now, given that the IMD expects a normal monsoon this year, the pickup in rural demand should quicken over the next several months. Add to this the fact that private companies, especially ones in high investment sectors like cement, steel, and mining, already have significant order backlogs and are receiving fresh orders mostly thanks to the centre's infrastructure push, and you have a situation where companies will need to add new capacity quite fast. But this is where the election uncertainty is playing a spoilsport. The broad unofficial consensus outside of social media seems to be that the Narendra Modi government will return for a third term, though with a smaller majority and maybe even only with the help of alliance partners. Yet, the level of uncertainty brought on by the campaigns of the Congress and its allies is just enough to make most people hesitate before putting their money behind their bets. Companies too are waiting. They won't officially say it, but this wait and watch strategy is clear in conversations with industry bodies. The problem is also that there's very little consensus between India's two biggest political parties on key policy aspects that affect investment sentiment. For example, the Congress has talked extensively about bringing in a GST 2.0 with fewer and higher rates. The BJP seems content with the current setup. GST is a core ease of doing business aspect. Constantly fiddling only adds to the uncertainty. The BJP also seems fine with the corporate tax cut it implemented in 2019. But this has been something that the Congress has been lambasting ever since then. So there's a chance that if they come in, they might change it. There's also no agreement between the two parties on how to generate employment in the economy. Should manufacturing or services be the source? It's to be expected that the Congress would come up with radical ideas to attract voters that are tired of the status quo. But considerable uncertainty also seems to be coming from PM Modi's own assertions that he'll hit the ground running in his third term with big bang reforms. What form will these reforms take? How will it affect the business environment? Which sectors will be the focus? These are all questions that affect the investment confidence in the economy, and there are no answers to these yet. The wait will also likely be a long one. The election has been scheduled to run for a whopping 6 weeks from start to finish. Add to that the formation of the new government and the presentation of the budget, and it's only in mid-July that companies will have any clarity on the economic direction the country will take. The policy prescriptions from this election-related pause in investments are limited, but there are a few. At the outset, the Election Commission certainly needs to look at shortening the length of the election process in India. This is also perhaps the first time in about 30 years when there are strong fears that the overall political consensus between both parties on key political aspects seems to be fracturing now. That is, the two main parties don't seem to agree anymore on some basic economic issues. The Indian government also needs to inculcate a sense of policy certainty regardless of the party in power. Companies should not feel so uncertain about key aspects of the economy and how they're going to progress under any new government. Perhaps it's time to think about a list of reserved policies that won't be changed for a certain number of years, regardless of a change in the government. But on that note, that's all from me. Thank you for watching.